Alright, so far we've looked at the principles behind our framework of explaining the price movements of any market, and we've also looked at the different types of charts that we personally use to depict that behavior, namely candlestick charts and market profile charts. Now we're going to be getting into the nature of market behavior, of taking all those things we've learned so far in terms of large level principles and applying them to the actual complex behavior of the markets. And to start at the most basic level, in terms of financial market behavior, you have two conditions in which markets can exist. Condition number one is that markets can be trending, and condition number two is that markets can be balancing. Now we're going to look at both of these conditions from the context of everything we've learned so far. Alright, now this is a candlestick chart of a market. Now forget about what market this is. At this point, that's irrelevant. We're just trying to look at market behavior in the context of our framework. Alright? And like I just said, markets really can do two things. They can either be trending or they can be balancing. And what do we mean by this? If you take a look at this chart right now, okay? Let's start from here. In this phase, markets are trending. They're making a directional move higher. Here, in this little area, you see that they are moving sideways. This means that they're balancing. Okay? Then they move higher again, do a little balancing, a little more balancing, higher again, balance, and then higher once again. Okay? Now, what does this balancing mean in terms of the framework we've learned about? If you recall, we learned that markets exist to facilitate trade. Alright? So, what the markets are doing when they're balancing is they're facilitating trade. When they're balancing, they have found a value area in which buyers and sellers agree that this is a fair price in which to transact. And when markets are trending, they're moving away from value. Let's take this area as an example. Here the markets have been moving sideways for a number of days. Each one of these is a day. The vertical lines separate the days. So the markets have been moving sideways for a number of days. This means that buyers and sellers have agreed that this is about fair value and nothing has changed in their perception to make prices move away from this area. But then you get this directional move. And all of a sudden now prices are up here and we're transacting up here. This is where the transfer of shares is happening, and now buyers and sellers are doing business up here as compared to doing it down here. Now what caused this change? Well, that is something that is not the relevant piece of information here. It could have been anything. It could have been a supply or demand change in the marketplace, right? Like we looked at in the example of the bread. Or it could have been some news or rumor item that caused people to get excited about the market and buy it up, even though the real demand and supply equation hadn't changed. That's the irrelevant part. The relevant part is that whatever it was that caused this, right, it caused value to move higher. This was value before, and now value is here. Alright? And so to do that, the market had to trend away from this balance area and reach a new one. And then the same thing happens here. The market trends away from this balance area and reaches a new one. And so these buyers that make these directional moves, the reason why they're buying is that they feel the real value of the market is now higher than these prices where it's transacting volume here. And so they buy it. And momentarily, they're more aggressive than the sellers, right? Prices go up because buyers are more aggressive than sellers. And what more aggressive means is that they are willing to pay the price that the sellers are offering. Okay? So sellers, let's say there's a bunch of people willing to sell it at 163. the buyers are reaching out and buying it from the sellers, and then when the sellers are done at 163, the buyers are looking for more. Is there more at 163.5? Is there more at 164? And they're continually buying it, and this causes the price to move higher. Now, in any trending phase of the market, in any one directional movement, if it's an up movement, buyers are consistently more aggressive than the sellers until we reach a point like here when they become equally aggressive. And now they're transacting at similar prices. Okay? Now they agree on value. And now we balance. The market finds a stopping point here and then moves back and forth sideways as it transacts trade. And what will happen is this pattern will keep happening. We'll trend, we'll find a stopping point, we'll balance around that new stopping point, and either we go back down if now this is seen as an unfair area, now value seen lower, or we'll keep going higher in search of new value areas in which to transact trade. Now let's take a look at this from a different perspective so we can understand it better. What I've done now on this chart is I've overlaid over top of this chart a market profile graphic. Now, like we had discussed before, market profile graphic can be shown in terms of time with the period letters A, B, C, D, or in terms of volume, which we had shown beside the time periods. And they're going to be very similar because, again, the more time the market spends in a certain area, the more volume it's going to transact there. So what you're seeing here is the volume profile chart. Okay? And what this basically does is it takes this bar chart, this candle chart that's going up and trending, right? And it shows you what kind of volume happened at each specific price, right? And so you see here that the price of 100 and around 162 or so, this area was, in the context of this whole move, this is the area that the market spent the most time on, transacted the most trade at. All right? Now, what you have to realize about the markets is that their two basic conditions, like we said, are trending and balancing. But the balancing condition is what the market does about 80% of the time. Estimates range between 70 to 90% based on the market. But in general, that's what the most of the time the market spends doing. And this makes sense if you think about the purpose of the market. Like we said, its purpose is to facilitate trade. And it facilitates trade when buyers and sellers agree on a fair price. And so it makes sense that it spends the majority of the time doing its very purpose. The other parts of the time where it's trending are the times that either buyers or sellers perceive value to be different than what it is currently based on any given factors, and they move price away from it, right? They reject it. So this is called initiative activity. When price moves like this away from an area, it's initiating a move towards a different value area. So it's called initiative activity or trend. It's the same terms. Here it's called a balance area or trading range. Again, the same interchangeable terms. So now when we look at this profile graphic, we can quickly see just at a glance, here was a great value area. There was a lot of volume transacted here. Also here. Also up here. Right? So we get to see that very quickly. And we also see the times when there was a rejection of value, when there was not a consensus based on what? Lack of volume, as you see here. You see here in this strip right here, there was no volume. The market was moving fast right through this area. And if you look at the chart, it shows you this is that time. This was moving, boom, right through this area. And again here, the market moved from here up straight right through this area. So now looking at it from the context of the market profile, you can quickly see balance areas, trends, balance areas, trends, balance areas, trends. Right? You can quickly see that this is what the market is doing. And this is why it's helpful to look at the market from different points of view. It just makes things visually easier to grasp when you have the two different points of view. Now the next thing you have to realize about markets is that they're fractal in nature. Now what does this mean? This means that all these patterns that you see, these balancing and the trends, happen all the time in all degrees of time. Okay? Now let's explain this a bit further. This means that when you're looking at this time frame and you see that this is a balance area and this is a trending move, if you zoom out, right, and take a bigger picture view, well, you can label this whole thing that includes this balance area, this whole thing is one trending move, right? So I don't know if you've ever seen those things called like the Russian dolls, where you have a big doll and you open it up, the doll opens, and there's a smaller doll within it. And then you open that doll, and there's a smaller doll within that, and so on and so forth till you get to the smallest doll. Well, it's the same type of thing in the markets. You have a big move here. This is the trend, right? This is one trending move higher. But then within that, you have smaller trending moves and smaller balance areas, right? And if we were to zoom out of this, we would find that this itself is part of a larger balance area too. So let's go ahead and do that. Okay, now what we're seeing is a daily chart of this same instrument, this same symbol. Okay, and what we're noticing is, see this area, this little up move here that just looks like it's just part of this big sideways area? Well, this is exactly the area we were looking at that was showing the big trend, right? And if you were to look closer at this, you would notice that this was the up move, this was the balance, this was the next up move, this was the balance, next up move, the balance. Yet, when you look at it from this big context, from a daily time frame of a couple of years, you'll notice that this whole move itself was within this big balance area, right? And then if you look at this balance area and you zoom out even further, well, let's do that right now, you notice that it's part of a trend itself. It's moving higher, 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 higher. Now it's trending and it's potentially going to move higher. So what you have to realize about the markets is their fractal nature. And this is what makes them so complex. Yes, we're seeing trends and balance areas and trends and balance areas, but they're happening all of the time in all degrees of time. What may look like a simple trend, right, can be part of a larger balance area. So you always have to zoom out to the larger time frames to get the real picture of the market. And this gives you a much better context, okay? So for instance, when we were looking at this up move on its own, and it was looking like this really strong up move that could just go on forever because there's nothing in its way, when you look at it from this bigger context, that it's just in one big balance area, you'll notice that what's in its way is this potentially big resistance area up here, this previous high where value got rejected really hard down and sellers got really aggressive. It's moving back towards that again. And we'll discuss the significance of that later. But the point is that you can never look at anything by itself. It's always part of a larger picture. And then that itself always has smaller components to it too. And it's always just made up of either trends or balances, both on the higher time frames and on the lower time frames. And this is how you can characterize a market.